Anthony Grasso here, bringing you financial news you can use. In this video, I'm going to do a stock analysis on Alibaba Group Holdings Limited. Should we invest right now into this Chinese company with all the regulatory crackdowns going on and possible default of Evergrande? Well, let's find out today. I'm going to go over the summary of the company, its product offerings, recent headline news, financials, analyst projections, and give up my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps, and consider subscribing and hit that notification bell if you'd like your daily stock reviews and recommendations from an unbiased source. So let's get right into it. So this video is brought to you by Webull, where you can trade stocks and cryptocurrencies, or you can get 2 free stocks if you open up a Webull brokerage account and deposit any amount into it. Use my link down below in the description to get signed up today. So Alibaba Group Holding Limited, through its subsidiaries, provides technology infrastructure and marketing reach to merchants, brands, retailers, and other businesses to engage with their users and customers in the People's Republic of China and internationally. It operates through 4 segments: its core commerce, its cloud computing, digital media and entertainment, and innovation initiatives, and others. Now, basically, it's a Chinese multinational technology company specializing in e-commerce, retail, internet, and technology. So the company provides consumer to consumer, business to consumer, and business to business sales services via web portals, as well as electronic payment services, shopping, search engines, and cloud computing services. It owns and operates a diverse portfolio of companies around the world in numerous business sectors. Alibaba is one of the world's largest retailers and e-commerce companies. In 2020, it was rated as the 5th largest artificial intelligence company. It also is one of the biggest venture capital firms and one of the biggest investment corporations in the world. So yes, you can say this company is a monster. So let's go ahead and look at some of the news that's going on right now. So one of the biggest news stories that has been going on for now over a year is China's regulatory crackdown on technology companies. Now, this has spooked investors and wiped out billions of dollars in value from the country's internet giants. Now, the legislative onslaught began in November of last year when the huge initial public offering of billionaire Jack Ma's financial technology company Ant Group was suspended. Since then, regulators have introduced anti-monopoly legislation focused on the so-called platform economy, which broadly refers to the internet companies operating a variety of services from e-commerce to food delivery. Regulations have also aimed at bolstering critical data security and protection laws. As a result, high-profile technology companies have faced investigations and punishments. E-commerce titan Alibaba was fined $2.8 billion in an anti-monopoly probe, and China's largest ride-hailing firm Didi was forced to stop user registrations while regulators conduct a cybersecurity review of the company just days after its U.S. listing. Now, according to this CNBC article, experts flagged a number of risks, including continued regulatory scrutiny, geopolitics, and uncertainty on the impact of business models for investors to look out for. Now, looking at the Evergrande crisis. Now, Chinese property developers have made last-minute ditch efforts to avoid bond defaults after regulators piled on the pressure to ensure embattled home builders repay their debts on time. Now, I bring this up because if Evergrande defaults, that investors will be spooked from the broader Chinese market in general, and I think Alibaba would have a negative short-term impact on the stock price if that were to happen. Now, let's go ahead and look at some of the fundamentals of the company. Now, the stock is currently trading at $165 a share with a market capitalization of around $449 billion. Now, the last reported revenue point for quarter 1 ending in June 2021 were 769 billion Chinese yuan with earnings of 147 billion Chinese yuan. Now, the next reported quarter 2 earnings will be around February 2022. The next expected revenue point will be approximately 910 billion yuan with about 131 billion yuan in earnings. Now, I would point out that the revenues are expected to increase over the next few years, but earnings are expected to stagnate or just slightly increase year over year. Now, the revenue expectations in 2024 project around 1.27 trillion yuan with earnings of 176 billion yuan. So significant increases in revenue growth without the expectations of earnings growth. Now, but Alibaba has high quality earnings and the trend is still up but just being it slow. Now, its price to earnings ratio is only 19.41 times, which is good. Now, Alibaba's future return on equity, though, is forecasted to be low, 3 years time, approximately only 13.3%, and Alibaba's current net profit margins of 19.2% are lower than last year's, which were 32%. Now, Alibaba's short-term assets do exceed both its short-term liabilities of 368 billion yuan and its long-term liabilities of 236 billion yuan, so that's a good thing. And its debt-to-equity ratio of 13.6% is considered satisfactory. Now, Baba's debt-to-equity ratio has reduced from 30.6% to 13.6% over the past 5 years, and Baba earns more interest than it pays, so coverage of interest payments is not a concern. So let me bring it back over here. So what do the analysts say about this one? Well, the analyst consensus is a strong buy with a median price target of $240 a share over the next 12 months, with a high of $330 a share and as low as $190 a share. So going over a few of the analyst reports in particular, the new Construct report has a buy recommendation on Alibaba based solely on the fundamentals. They say an attractive rating means that the stock has strong upside potential compared to low downside risk. But they're just looking straightly at the fundamentals and not any outside factors. Looking at the Street Quant Ratings report, they recommend a hold. The primary factors that they have impacted their ratings are mixed, some indicating strengths, some indicating weaknesses, with little evidence to justify the expectation of either positive or negative performance for the stock relative to most other stocks that they cover. Now, the company's strengths can be seen in multiple of areas, such as its robust revenue growth, largely solid financial position with reasonable debt levels by most measures, and reasonable valuation levels. However, as a counter to those strengths, they also find weaknesses, including disappointing return on equity, weak operating cash flow, and generally disappointing performance in the stock itself. Also, the Ford Equity Research Team has a hold recommendation on Alibaba right now, and as a result of their systematic analysis of the 3 basic characteristics that they look at, which is earning strength, relative valuation, and recent price movements. And they said the company has managed to produce a neutral trend in earnings per share over the last 5 quarters. However, while recent estimates for the company have been lowered by analysts, Alibaba has posted better than expected results. And they said based on operating earnings yield, the company is undervalued when compared to all the companies that they cover. Share price changes over the past year indicates Alibaba will perform very poorly over the near term. So am I a buy, hold, or sell recommendation on Alibaba? Now, here are my thoughts. Now, first, let's talk about the 1,000-pound gorilla in the room. China is cracking down on technology firms right now. Now, we did see a $400 billion stock sell-off in the market in general across the board. Can we honestly say that the worst is over and one day that the great giant Alibaba will regain its glory? Now, recently, shares are trading lower throughout September and October amid weaknesses in Chinese stocks across the board, mainly due to concerns in the real estate sector based on the continued China-based real estate company Evergrande uncertainty, which has weighed on the broader Chinese market in general. Investors continue to weigh the possible default of Evergrande. Now, the gaming, education, and technology sectors have also been under regulatory pressure in China this year, which has driven volatility in the overall market. Now, regulatory risk is real in China, and it's extremely unpredictable. Back in July, China announced it's cracking down on stocks that trade on U.S. exchanges under the ADRs, which is the American Deposit Receipt. They are effectively a way for U.S. investors to buy stakes in foreign companies. Now, China is stepping up its oversight of the flood of Chinese listings in the United States, which are overwhelmingly tech companies. But right now, my recommendation is I am a cautious, long-term bull on Alibaba in general, but outside factors beyond Alibaba right now make this, right this minute, I am a short-term bear on Alibaba for the near term. If you're in the long-term bull, I would wait and bet on the default of Evergrande. Alibaba is rock solid in terms of revenue and shows no signs of slowing down. If you're a short-term investor, trading the swings could be profitable. Also, if Evergrande defaults, I would buy Alibaba after that happens and then hold for the long term. The reason I think is investors will get scared of investing in anything in China and start selling off the day that happens, which would make Alibaba a real bargain at that point. Right now, it's already getting overbought on the short-term basis. its relative strength index, the RSI, is getting to a level that's been followed by pullbacks in the past, and it still hasn't gotten back to its trend line going back for the whole year. Yes, the risks are extremely high with this one. Some would say the risk outweigh the rewards in the short term. You might want to stick this one out and put your money where the rule of law is not up to one man in China. Foreseeable future growth is low and slightly increasing, and perceived risk is high. You have the Evergrande spillover, energy crisis, $2 trillion in ADRs, which China is cracking down on. To even invest in ADRs, investors have to weigh the risk of tensions between Beijing and Washington, which right now remain elevated. But looking at another aspect for the long term of this is how Alibaba has entrenched itself in their existing dominant market position for possibly decades to come by investing billions of dollars into President Xi Jinping's common prosperity drive, which is seen as many as a way to ease China's worsening inequality. Now, this policy is seen as a Maoist and spooking the prosperous policy. I personally do not believe that it was done voluntarily. As Alibaba grows bigger in the future, China will tend to strengthen its control over them. I put a 12-month price target in Alibaba at around $190 a share. But in the near term, I think there's a lot of downside risk to bring it possibly down to below $130 a share, depending on how any negative news that comes out. We can't predict everything, but there's a lot more stocks out there that have a greater risk versus reward prospects. I'm just saying. But what do you think about the future of Alibaba? Please leave your comments down below. And so there you have it, folks. As always, don't forget to smash that like button down below and consider subscribe and hit that notification bell for like your daily stock reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.